I welcome you on this call. Thanks a lot for joining and taking out time from your busy schedule. I can totally understand you must have been bombarded with so many queries, so much work related to IPO. Without wasting much time, if you could just explain the company's business model in simple terms, that would be great.
Thanks, Anil, for having us on the call. You know, uh, uh, at Capillary, Anil, we power loyalty programs for brands.
Mhm.
So if you've recently flown an Indigo, they talk about please sign up for Blue Chip. When you sign up, you get points for every Blue Chips for every flight you take, and then you earn Blue Chips and you can redeem them. Or if you've been to a Taj, they give you new coins for every time you stay there, right? Or if you've been to a Pantaloons, you get points for buying, and then you get coupons and offers, and if you're part of that green card program they have, right? So basically, any kind of a long-term retention program that a brand runs for its consumers is loyalty. Now, we power these loyalty programs. These loyalty programs run on our software. The names that I gave you, Indigo, Tata Group, Pantaloons, are all customers of Capillary. Right. So we today work with 19 of the Fortune 500 globally. We're a fairly global business. All the customers in 47 countries, all the way from US to Japan. Loyalty is the only thing we do, but we're amongst the best in the world at it. So there are lots of marketing analysts who give deep reports about the space, about loyalty. Forrester is the largest of the analysts. You also have reports from Gartner, from Everest, from Quadrant, etc. Pick any of these analyst reports on loyalty, you will see us in the top two globally. Right. We also today work with 19 of the Fortune 500. So that's our business. It's a software product hosted in the cloud, which helps our customers run their loyalty and customer engagement, retention and rewards programs. The way our business model, Anil, is it's a multi-year recurring revenue subscription, right? So customers sign up with us for 3, 5, 7 years and pay us a recurring annual fee, usually annually or quarterly is what they pay us. But, it's a fee that they sign up for, which is linked to the number of customers or the number of transactions on the platform. And as they grow, the number of transactions grows similarly, our billing grows with them, right? So it's a typical software as a service annuity type model.
Got it. Got it. And if you could just share breakup of your customers geographically.
Anand, you want to take that?
So Anil, so about 55% of the revenue comes from US, about 20% from Europe, and about 25% from Asia. And this kind of mix that what you would see for the TAM for any large SaaS software spend globally. So I think now at a right mix in terms of revenues in all these geographies. Um, we are still kind of a new player in the Western markets, both
Okay.
US and Europe. Like US is about 4 years old for us. Europe is about 2 years old. So there is a lot of growth headroom in all the markets as we have a small market share at this point in time.
Okay. So you mentioned US accounts for nearly 55% of your revenues, but you are only 4 years old in this geography. Is it
Correct.
through some sort of acquisition that you have this much revenue coming from there?
Yeah. So we have done 4 acquisitions, Anil, in the last 4 years. And a part of the growth. So if you look at the last 3 years, we've roughly gone from about 207 crores in FY23 to about 598 crores in FY25. So about 60% of this growth has come organically, and about 40% has come in through acquisitions. And these acquisitions have been done in West. So majority revenue of these acquisitions is US and Europe.
Yeah. Having
Okay.
said that, Anil,
Yeah.
we've also won a lot of organic Fortune 500 customers in the US, right? So the DRHP talks about it. We work with the world's largest healthcare company, which is based in the US. We roughly sign up one Fortune 500 customer every quarter. So if you take the last few, when we filed our DRHP, we had 16 Fortune 500 customers. Today we have 19. So it's a mix of organic, inorganic in all our markets, US and Europe. Asia, of course, we haven't done any acquisitions. Asia has been all organic over the last, I'd say 16, 17 years now.
Okay. All right. And so 55% revenue coming from US and doing these acquisitions, it tells me that this is not by chance, this is by design. So if you could shed some more lights behind about the thought behind this, how do you see the US market different from, let's say, Europe or Asia, or for that matter, domestic market?
Okay, I'll
So
take
Anil,
that.
go ahead.
Yeah. So if you look at the US, loyalty has existed in the West since 40, 50 years, right? Unlike Asia, which is slightly newer to loyalty, although, everyone has a loyalty program now in Asia as well. So in the US, it's a fairly mature market if you look at it, right? So in fact, we have a industry report in the business section of the and if you look at most of our major competitors, they're all basically mostly in the US, right? So these are typically agencies like an Epsilon or a Merkle or a Kobe. And these tend to be businesses that were set up like 40, 50 years ago, right? So that ends up, so mostly in the US, it's these agencies that run loyalty programs. And there are, of course, a few software companies like us, Salesforce, who have scale at running these programs. So our approach to the US has been two-pronged. That one, you win customers as they come up with RFPs, right? So we're very well rated in any analyst report. So 65% of our new business that comes from one of these analysts or a consultant or an SI referring us, right? So our sales engine runs on these references coming in, and then so usually an RFP, it's a multi-million-dollar deal. If you look at our top 10 customers, they're pretty large, right? Just from the math. So that helps with sales. On the other hand, we have a very active M&A engine. So we look at smaller loyalty companies, competitors of ours who have a decent book of business but low gross margins. Not software like gross margins, services like gross margins, 15-20% gross margins is what they run on, while our software gross margins are like 65% plus, right? So we tend to buy these books of business out, migrate those customers onto our platform. So US and Europe have been for us kind of like a dual engine in that sense, both organically winning customers as well as through these tuck-in competitor acquisitions.
Okay. So if I say I've been following the stock market for almost 20, slightly over 20 years actually. I think it's first of its kind company which is getting listed, at least in the rewards and loyalty. Uh, Please correct me if I'm wrong. But anyway, my question is not this. The question is that how did you chance on this?
That's a interesting story. So we started, Anil, in 2008, just a bit before August of 2008 to be exact. We really two kids out of college. I graduated from IIT Kharagpur in 2006, worked for a year at ITC. Anand had graduated in 2007 and was at PNG at that point in time. And we both, wanted to start up, but we didn't have a big idea. So we kind of went with the way of saying, let's pick two sectors that are doing well. We picked mobile, and we started up exactly a month before Lehman Brothers tanked. If you remember, Lehman tanked on September 11, 2008,
Mm.
and there was a pretty bad recession, and stock markets went down, and all of that, right? So in that period, in that 1 month after we started, we were basically asking a lot of, we'd chosen retail and mobile, right? So we were asking retailers and all the mobile folks. We knew that we can build good software. We're out of IIT. Tell us, what problems do you have? And to our luck, everyone would say customers aren't coming back to stores. Our Diwali has been bad. Our same store sales are down. If you can solve this, we might be interested, although it's a recession. And then we would ask them, who your customers are. And if you remember back then, retail used to mostly put stuff in the store and it will sell, right? Amazon really changed that mindset of, no customer is important, right? So,
Mm.
and so most people would say, no, we don't have a program. And then, some of them who had a program would say, no one wants to carry these cards. No one wants to fill these forms. So we said, okay, we'll use the mobile number as a unique identifier and use that to run loyalty programs. So that's kind of how we got into this space, right? So it's been a
Okay.
very interesting 17 years now, through building the product up and serving some of the largest customers in the world.
Got it. And I assume that these early customers were not Fortune 500 companies.
To our luck, in a recession, people need to do more, right? So our second customer was Birla Group. Our first customer was Future Group. So we did, our networks were the, networks from ITC, PNG, IITs, right? So wherever our seniors were kind of introductions into first. So it ended up being some pretty good companies, by the way. Like our first few customers were really giants on whose shoulders we learned retail or loyalty or marketing and built on top. Yeah. I mean, they were not Fortune 500, but they were definitely Fortune 500 for India.
Yeah,
Right.
got it.
So,
Got it.
yeah.
Yeah. You named some
Also,
companies. Yeah.
these are also, Anil, some of the more forward-looking and open to experimentation kind of companies, the ones who initially signed up. They
Yes.
helped us build the product. They guided us through the process. And obviously, in the initial years, you did a lot of experiments and learned together. So,
Mm.
like Madhura, you're always known that they are the ones who kind of bring in new technologies, new things to the retail world. So, I think we learned a lot in this process with that.
Got it. Got it. Fair enough. All right. Let's talk about M&As. So my understanding is that M&As are inherently risky. Unless it is access, it's a factor which is something like access to a specific technology or some sort of long-standing advantage that a merger and acquisition provides. It should be best. It is best avoided. Uh, but you seem to have done fairly well in this space. So I would like to understand from you, both of you, how it has been, experience has been, and also going forward, what are the kind of factors that you look at before deciding that, okay, this is the company that we would like to acquire? And also, if you can share if these acquisitions are outright purchases or share swap agreements.
Sure. I can take you through this. So Anil, few things over here, and you're correct. M&As typically are risky propositions, and we have a few guidelines to measure and minimize some of these risks. The first one being that we are not taking any product risk. What we are doing is buying loyalty companies. So loyalty is something that we know really in and out. We know the field really well. So what you're doing is buying these companies who provide loyalty solutions to the customers, and then you take over these companies and migrate customers from a agency or a people-driven model, which runs at 10-15% gross margin. Migrate them onto Capillary's platform, where it generates 65% gross margin. Right? So really minimize the risk on that front. You also minimize the risk by looking at the quality of customers that you are acquiring. Capillary knows how to operate with large enterprises. So we typically buy companies which have large enterprises. And you would also evaluate the team that you're going to get. So you kind of do a bit of a culture assessment with that team. So some of these kind of help us minimize the risk from point of view of buying something that you won't know how to run. Right? So these are the basics that we first look for. This is like level one of diligence. The second level of work is at what price you are buying these. So typically our acquisitions are anywhere between zero point 0.5 to 1.5 times the revenue, and kind of that gives you some room for error, because we know that not 100% of the revenue would be retained. We have our internal models. We retain about 80% plus of revenue, but you want to kind of leave some room for error in the commercial terms as well, because you want all of these M&As to be delivering 20% plus ROC. Right? The third that you look for is that you buy these companies to integrate them completely. So day one, you take certain steps in terms of integrating, say, HR, finance, and management teams, and
Yeah.
all the relevant team heads from both the organizations are merged in day one. So you would basically have your tech merged with the technology team of Capillary. You would have the product team merged on day one, the customer success teams, sales teams merged on day one. So it kind of starts operating like one company from the beginning itself. So because you're buying them to completely integrate and bring them onto Capillary platform. And hence, over these four acquisitions, I think we have been able to maintain the culture, retain the teams, retain the customers, and also deliver a 20% plus ROC on each of these acquisitions.
Okay. And you mentioned that you spent something like 1 to 1.5 times of annual revenues of the
Right.
target companies.
Yeah.
Okay. And typically speaking, your customers tend to stick around for 4 5 years.
Like our churn has been in the range of 5 to 7%. So technically, if the customers would be on Capillary for like 15 to 20 years. Like some of the customers that we signed up in 2008, 2009 are still our customers. Again,
Okay.
Madura is a great example for that. Puma, like bunch of our customers in India with whom we started 17 years
Okay.
back, they're still our customers.
Madura is basically Aditya Birla fashion.
Yes, yes.
Yeah.
Yeah. Okay. And Aditya Birla Fashion is quite big that way. They have lots of other brands as well. Uh, okay. So the also, yeah, one thing that remains unanswered as of now. Yeah, how do you structure these deals? Are these outright purchases?
Yeah, these are outright purchases. We take over 100% control of those companies on day one, um,
No
and then
equity dilution.
sorry.
No equity dilution, no share swap.
Yeah, typically we have done 100% cash deals. There's some portion of the money
Mhm.
which is there in escrow linked to certain closing conditions, but these are outright 100% purchases on day one. Because as I was sharing, Anil,
Okay.
the idea is to acquire the companies and integrate them fully. You don't want it to
Mhm.
become a Frankenstein over a period of time. You want it to be like one integrated engine which is moving fast towards the goal.
Great. Okay. All right. Also, going forward, how do you see this? Would you like to follow the same playbook, uh, especially regarding M&A, because it appears that mergers and acquisitions are going to be uh, crucially important because you have succeeded in this.
So Anil, there are actually, or rather, the way loyalty evolved in the West, and loyalty is like 4 or 5 decades old industry. It evolved
Mhm.
in a manner where there are lots and lots of agencies which are subscale at this point in time, and most of them are not growing. Some of them are declining. So there is actually a good opportunity for a roll-up play over here. You can actually acquire a lot of companies, uh, provided you are able to execute on that strategy well, which we feel confident of having done for over the last 4 years. We feel that there's a good opportunity of roll-up play in which you acquire companies, migrate them onto Capillary platform, generate 20% plus ROC, and that kind of helps you with the scale in the market. So I think and that's going to continue to be one of our strategic means to grow.
Okay, fair enough. Uh, let's talk about debt levels. Going forward, if you plan, how do you plan to fund these acquisitions?
And the business is actually generating a lot of cash. Just in first half of this year, the business generated about 55 crores of cash, and and this flywheel has sort of started. Over the last 2 years, FY24 and FY25, we generated about 55 crores of cash. We've been able to generate that much in just first half of this year. Um, this would kind of become clear if you look at the P&L. The beauty of SaaS model is that you build your product for a vertical, and then subsequent customers that you get for that product vertical, you're able to onboard customers on without having to do any customizations or some very minor changes for the needs of that. So that kind of generates cash for you to invest on R&D. It also generates cash for you to invest on future acquisitions. So both these have been helping. Like investment on R&D has been helping Capillary keep its product best in class. So part of our investment goes towards that, and the other part we look to use for M&As. We
Got it.
don't have long-term debt on our books. We do have some
Mhm.
short-term working capital cycles, working capital lines. Yeah. So the P&L and or the balance sheet is pretty healthy that ways. That gives us confidence to do a lot more.
Got it. Okay. Okay, your business has been doing very well. You have been growing at a very healthy CAGR year on year. Uh, your profits, you say that free cash flow, the business is generating a lot of cash, but it is not getting reflected in the profits, profit margins. Uh, yeah, so maybe you can shed some light on that.
Sure. So Anil, the EBITDAs for the first half of this year are about 40 crores. But you see a gap from the EBITDA to PAT. Reason being that we have done some of these acquisitions in the past, and also investment on R&Ds. Those are the ones which are getting amortized, and that's what you're seeing as delta between EBITDA and PAT. So, and the way we kind of look at business is how much cash the business can potentially generate, which kind of gives you ability to invest on both R&D and acquisitions.
Mhm. Okay. Uh, your business has just turned profitable last year. If I look at just net basis. So don't you think it's a little too early? Anish, you can also chime in this. Uh, do you find that this is basically where this is coming from is that as a public market investor, we are seeing lots and lots of companies which were running into losses and suddenly in one year uh, they become profitable and then they launch IPO. So, so yeah, your thoughts on this?